Good morning, traders. Today is April 8th. My name is Brad Matheny. This is the MENT.com investor video. This video is designed to help longer-term investors understand what's going on in the markets and to prepare for the next 2 to 12 months going forward. I want to urge you to visit MENT.com. This is my website. I do all the research. I've been studying the markets for over 30 years now, learning about technical analysis, been developing software for traders in the late 80s, early 90s. I developed the Candlestick Forecaster software series with my ex-partner, Gary Wagner. And over the past 15 years, all I've been doing, actually now 23 years plus, all I've been doing is custom development of advanced trading systems, modeling systems, and fully automated trading systems for traders throughout the world. What I have been doing, what I've learned over the last 20-some years is impossible to try to recreate. Imagine developing thousands of trading systems, seeing what works, seeing what doesn't work, and learning from some of the best traders on the planet how they trade and how they manage their capital. My job is to try to keep you informed, to do the research, to provide you the resources and tools to grow your capital and to stay away from the biggest trends and biggest risks. Stay away from the biggest risks in the market and stay attuned to the biggest trends in the market. So please come visit my website. Try my Expert Growth membership for 60 days. It is well worth the effort and the cost, especially when you understand that I'm going to be capable of helping you catch and trade the absolute biggest trends on the planet using my MENT rotational modeling system. This is the results of the MENT rotational modeling system through the end of February. I'll show you the results through the end of March in just a minute. Okay, now the Expert Growth membership page looks like this. It's very simple. You have a number of resources here that you can gain access to, but everything is available here. You have member updates. You have video analysis, kind of like I'm delivering to you right here. You have my custom indexes, which we'll go through a couple of custom indexes in this video. The weekly hot list, which show you where opportunity is setting up and which sectors are trending and which sectors are not. Weekly stock picks, SPY cycle patterns, member support, and your account. Ideally, ladies and gentlemen, this is designed to give you everything that you need right here to be able to access right here. And then if you need more, you come up here and go to my MENT Live Trades algorithm. These are hundreds of stock symbols running on algorithms, trading algos every day. And you're going to be able to find literally countless 20 to 50 new trading signals every day, every week out here. Sometimes 20 to 50 new ones every day, but not likely. 20 to 50 new trading signals roughly every week with MENT Live Trades. Okay, let's get started. First, what I want to do is highlight this long-term chart. Now, this is going to become a staple of the investor video. This is going to be something that I'm going to go over on a regular basis with you to highlight what's going on. This is the SPY on a weekly basis, and what I'm doing is I'm applying what I call my Fibonacci price amplitude arcs to this data. Fibonacci price amplitude arcs are a custom analysis model that I use to measure price amplitude, price frequency, and price vibration. I want you to understand that what I'm looking for with these price amplitude arcs is I'm looking to align this circle at or near a peak, dead center right here. And I'm using these zigzag indicators to measure price correction and price rotation so I can find the peaks and troughs very easily. So essentially every little peak, every little top represents a vibration at an origination point for the Fibonacci price amplitude arcs. Then, as I'm measuring the price amplitude arcs, which measure frequency going out, I'm looking for how price reacts to these amplitude arcs as they're moving. So, for example, this correction aligned very cleanly, broke through this correction, ran into resistance, found support, came back up. Same thing here. Ran through this resistance area, collapsed, back below it, found support, rallied back above it. Same thing here. Ran through the resistance area, collapsed, rallied back above it. In this case, it reacted before the resistance area. Then I will look on the opposite side. For example, right here, we see this green arc right here, this arc. You can see how price came down to the red arc, moved up, came down to the green arc, moved up, and came down to this lower level and stalled. Well, why wasn't this level identified through the arcing area? Well, in reality, it was. It was identified right here through this low level, right here, this lower arc level, came right across and identified our bottom. But what's important is by learning where these price amplitude arcs cross going forward, we can attempt to project where price may go. So for example, I'm looking at this cross right here where these two green levels cross. And what I've done is I've lined it up to where I've drawn a line. I've readjusted this line accordingly. I'll readjust it just a little bit for you. Up into this area. And what I want you to realize is this arc now aligns with this cross right here, right at this price peak. So what I believe is actually happening, ladies and gentlemen, is that the SPY, let me spread this out a little more. The SPY is attempting to mount an advance, which will be a move up to this level, 440 roughly, 435, 440, right in this area. Will stall out, will revert back down to this area here. Try to line this up. Will revert back down to this area here, roughly 395, 394. This will be the end of wave A to the upside. This will be wave B. In fact, let me label these. A. B. And eventual C up here. And what we have, ladies and gentlemen, is a very broad upside price move in the SPY, which will likely stall out near a new all-time high in late 2023 or early 2024. This all-time high should end around 494, 495, 496, and then we enter into another correction period back down into this area, which will be D. And I've highlighted this by drawing this very broad support channel here. This is the next support channel that we're attempting to set up. So right here, understand that we are in the midst of setting up this support channel right now. We're getting into this zone right now. It's going to be very volatile through here, but eventually this level will turn into very broad support moving forward. We also have a support level down here. So let me clone this. And just for those of you who are interested, we have a very strong support level down in this area that is applying to the markets right now. This was a return of an apex right here, a beautiful apex peaking formation. So I would say in reality, this level is right about here, just below this B bottom. Okay. And then we have our D, we have our E wave peak up here. The E wave peak would be the end of wave 1. This constitutes a full A, B, C, D, E wave to the upside. This would be wave 1. Let me label this as wave 1 up here. And then this would set up as our wave 2 correction. And this is going to be 2025, roughly, starting in May of 2025, April, May, roughly, going all the way down to possibly November 2025. This would be wave 2. Then we would start a new advancement wave to the upside after our correction. And I don't know where this one is going to go yet, but this is the structure of price based on Fibonacci. Now, the reason I'm doing this and presenting this information to you like this is I want you to see my expectations as of right now and how I will adapt these expectations to price as we go forward. I am, married to this in a way right now. I believe this is the most logical outcome for price going forward, barring any massive catalyst event. But I'm also, I will be adapting this to any events that occur going forward. So understand, if the markets were to reach this peak and there were to be some catalyst event and we were to extend the downward move without reaching this new high, which is critical as far as Fibonacci price structure and price amplitude, we need to establish this new high to establish the next upward trend. We fail to establish this new high up here and we only reach this level or anywhere in between here and there's price contraction back to the downside, particularly below this level. I will highlight this in dark purple. Particularly below this level, and potentially below this support level here, this green level, this B, then we have the risk of further downside. But I don't see that happening yet. I think the real downside risk is going to occur in 2031, 32, 33, maybe later. And because of that, traders, in my opinion, need to be prepared for the opportunity that's coming in this August-September timeframe, right over in here. And as we get closer to the base of this B level, which could come in June, July, August, September. And then we need to also prepare over here in August, September, October, November of 2024 for the next phase higher. Understand that we are going to have a downward move here. This is logical price structure. We are going to have some sort of a pullback at this level. This is going to be after the election. So understand we have the election in November 24 down in this area. Then we have some sort of a post-election rally, potentially off of some new president. Then we have some potential new catalyst event causing us to see this sideways formation. Eventually, we're going to move into a broader wave. Remember, wave 1 is typically the shortest wave of a price move. So wave 1 could be an ABC pattern or an ABCDE pattern. I believe we're setting up for an E, a 5-wave structure, but we need to see how it plays out. I don't believe we're going to see any real new all-time highs in this year. I think it's going to come in early 2024 near this C pattern here. So be aware that you still have opportunity in the market. It's just going to be a difficult 2 or so years to trade before we get into this mode. This mode here is the real opportunity. This is the real opportunity for your buying. This is going to be where the big trend is going to initiate. So buying in this area and or this area and or this area are going to be the greatest opportunities you have if my analysis is correct. You may be able to see 100 or 200% rally phase before we reach the end of wave 5 here. Okay, let's take a look over here at the MENT rotational modeling system. As of the end of March, the MENT rotational modeling system is still bullish weekly at 25% allocation, bearish daily at 75% allocation. Currently, we're off 3.23% in the trade. The trade entered bearish on 2/24. We are in a net single 1 position account here. We are still 50% bearish, 50% cash. We're off 3.32%. That's really nothing. This is the historical results of the MENT rotational modeling system. Take a look at this. You can see we are damn close to new all-time highs just a few months back. We rolled back over on this rotation. we catch another good trend here, ladies and gentlemen, we're going to be inching back up into new all-time highs very, very quickly. Meanwhile, the S&P is consolidated down here, pretty much done nothing. If you look at this orange line is the SPY trading $100,000 in 1996. If you just left that $100,000 in there as a cash position and let it ride up, you'd have about $620,000. If you traded it with the MENT rotational modeling system, the blue line, you'd have close to $1.68 million trading the same capital. And the difference is that we're taking advantage of price swings, we're targeting price targets, and we're essentially dynamically allocating our money. So this is really active management of capital, and you can see the performance here has been quite well. It actually reduces your volatility by nearly 35% compared to just buying and holding the SPY. Now, the longer term structure for traders, SPY is weekly bullish, daily bearish. Tran is weekly bullish, daily bearish. These are daily trends versus weekly trends. You can pause the video here to take a look. This is the MENT rotational modeling system running on these different ETFs and sectors. This is our allocation level for your trading account. Remember, you have two accounts. You have your investment account, which should be in your investment portfolio, trading your funds and or the SPY, and then you should have 10, 15, maybe 20% of your capital over in a trading account for taking discretionary trades. And if you're taking those discretionary trades, then you would have this type of an allocation setup: 35% in stocks, 25% cash, 25% metals, 15% bonds, or 35% stocks, 45% cash, and 20% bonds. I'm going to issue you a warning in this video. Actually, I did it in the metals video as well, but I'm going to be talking quite a bit about metals over the next 3-4 weeks because we're nearing a temporary peak in metals. So you need to be prepared that metals will not continue to operate like they have been for the past 2, 3, 4 months as a great hedge. We're going to see a stalling in metals that's going to happen within the next 3 to 5 weeks as a peak. And we could see 2 months, 60 to 90 days maybe of sideways trading before we start to see another price appreciation phase. Okay, so now from a trader standpoint, let's take a look at the U.S. Valuations Index. So the U.S. Valuations Index, this is part of my custom index feature for all MENT.com expert growth members. We're in this early bottoming stage like we saw back over here. You can see we're in this bottoming stage here. But we're also in the midst of just almost kind of like this. This was a late stage because the election was back here in 2016. We're in a fairly early stage basing bottoming prior to a major presidential election. I don't believe we're going to see the real valuations data start to increase. I don't believe we're going to see the markets really start to accumulate until later 2023 and into 2024. So that means we're going to see kind of a sideways basing mode like we saw over here, or maybe a little bit like we saw here. This wasn't a downtrend, but understand that we could be in 6, 8, 10 months of sideways moderate basing trying to get back above this purple level here before we start to see some real accumulation back to the upside. So be aware that even though we're seeing reflation, this is not a deep V bottom like post-COVID. We aren't seeing that. I don't believe we will see that. This is going to be an extended sideways basing bottoming mode setting up in the markets, not a deep V bottom with a lot of acceleration to the upside. Here is the accumulation cycle phase index, and you can see this is the SPY up here. I am very much expecting it to move up into this area, stall back out, and then eventually try to move back up into new all-time highs near the end of 2023, 2024. And this means that we could see this move sideways and stall back out, weakening above this green channeling level here before finally eventually breaking downward in later 2023 and really starting to ramp up and start to build a big accumulation phase. I don't think we're going to see a big accumulation phase in the stock market until after July, August, September. And then I really don't think it's going to become very evident that it's accumulating to many people until probably after June, July, August of 2024. That's my opinion. It's kind of a stealth rally here. The custom fear index is hovering up here near this 7.15 level, had been higher over the past couple of weeks. This is what's driving some accumulation into metals. I believe the fear index will weaken over the next 4 or 5 weeks as we move higher. You can see the SPY here at 409. Big difference from where we were back down here at around 404. It's only taken a few weeks to roll, but the next target is up here at 440, 441. So understand that we're looking at another 35-point rally to get back up here, breaking these highs over here. And this means that our sentiment index will likely rally up into 385, 395 area and then roll back over near this upper green standard deviation channel. And this is, again, what you should expect. 5 to maybe 10 weeks of upward movement in the SPY, then a rotation into late May, early June that'll last probably until July, August, September as a bottom, just like I showed you back over here. We're looking at this type of a move up until maybe June, May, June, early July, and then we're looking at a rotation back to the downside into, September, October as a base potentially, and then attempting to move higher. Okay, let's go to the metals trend index. Okay, this is a new index, kind of like my volatility index, which I'm going to show you in a moment. And this is the metals, I'm calling it the metals standard deviation index. And the purpose behind this is to show you where price is reaching into new trending territory and or channeling. So at this point here, you can see this depreciation cycle after the peak in COVID has continued to trend down below this channel. We're right at this channel again, which I believe is going to continue to act as a peaking pattern. So we have maybe another week or 2 or 3 in upward move in metals before it's going to reach this peak, roll back downward, and really deflate from, say, 2150 maybe is the high, maybe 2200, and then it's going to start to move downward, maybe 10, 15, 20%. And that's going to put us at a point where you're going to be looking at 2100 thinking we're off to the races, and I don't want you loading up on metals right now when this breakout occurs, or at least don't want to give you the impression that you should be doing this. In reality, if you wait 5 or 6 or 7 weeks, you might be able to buy it back at 1960, 1940, and get a much better price than chasing this rally phase. Remember, where you want to be accumulating metals is in these downward cycles. This is where, if you're going to be accumulating as a hedge, you want to be buying in these downward cycles. I actually started buying metals back over here in 13, 14, 15, back in this area in the downward cycle. And again, gold was 1360, 1340 an ounce, and silver was, $12, $13. At one point I was trying to get it around $11 from people. But ideally, you want to be buying during these contractionary periods, not chasing it on the way up. Now, granted, if you don't have a position in metals right now and you're trying to get in, just start with something you can live with, a small anchor position, be prepared, and then try to look for these opportunistic lower prices to get, to add to your position. Metals are going to be an excellent hedge over the next 6 or 7 years. Please understand that my analysis, I believe metals, gold could be trading above $7,000, $8,000 an ounce by 2030, 2031. That's 4 or 5 times where we're at right now. And I want you to be aware that, this is only really 6 or 7 years away. So understand that we are nearing this contraction. We're likely going to peak out and consolidate down into metals. And where this becomes evident is right here in my gold cycle index. This is a custom index that I use to measure appreciation, depreciation, and trends. And what I'd like to point out is this 45 level, right about this level, right across here. Okay, we do not get into any massive appreciation in precious metals until this index moves above this 45 level. Then normally within 2, 3, 5, 6 months, we start to get that real massive appreciation phase. Now, it could happen sooner over here, okay? But we're still at 39.5. We haven't gotten above that 45, 46 level, like right over here. We haven't gotten that real pop into extreme appreciation. And normally the extreme appreciation occurs in the later 12 to 15 months of this cycle. So just like we saw here, the later 12 to 15 months was a broad appreciation. The later, these are monthly bars, 12 to 24 months here was broad appreciation, and then we went into a depreciation cycle. So we may still be 6, 7, 8 weeks away or months away from moving into a broad appreciation cycle. But from a trader standpoint, it's a great time to be looking for accumulation below, say, 2020 on gold, or if you're lucky enough, below 1960, 1970 on gold. We may see a price level below 1940 again, possibly, if we see some sort of a pullback. You can see back over here, we rallied up a little bit, got up into the 40s, and then pulled back quite a bit. But normally once it gets above 45, then we have about 6 or 7 months, maybe 8 months later, we start appreciating. Same thing here. Once it pops above 45, gave us about 6 months into pre-COVID, and it started appreciating. This time could be different. We'll see. But we haven't cleared that 45 level yet, and we don't have a strong close above my trigger level, so we're waiting for it to happen. But again, pay attention to this research and pay attention to the MENT rotational modeling system. What I'm trying to tell you here and trying to show you here is that the real opportunity, again, look at this move. This is a, if I can get to it, 25, almost 26% move to the upside that we are now targeting. And remember, I was calling for this move back over here when everybody was telling everyone it was going to continue to move downward. I was looking at this as a wave 4 bottom. This is a new wave 5 structure. Given the fact that wave 3 took place from roughly here to here, I want you to understand that, and let me move this to yellow, this, I'll find a different color. Make it bright blue. This is wave 3. This is a big, beautiful, massive wave 3. This is wave 1 down here. So here's wave 1. 1, 3, and now potentially 5. 5 could be bigger, could be equal to or bigger than wave 3. So understand that wave 5 could be a massive move that nobody has ever considered, or very few have really considered in the SPY, and could be, this is 350%, sorry, yep, 350%, and this is 190, so let's make it roughly 225, 229, right there. It aligns with my Fibonacci price amplitude arc. And if that would still be smaller in percentage size, 809 in total points and 322. So it would be bigger. So we would have to likely be down in, it could still be in that range. Possibly in this range here. So again, about 738. That would be a 112% rally from the base in December and October, December of 2022. And it could still be a massive 85, 90% rally phase from where we are right now. Now, it could actually still be even bigger. These price amplitude arcs suggest that it could continue way out here, which is a 238% rally, up 831 points in the SPY. But let's not fool ourselves with, you know, potentials. I mean, hypothetically, it could be $2,000. Who knows? Let's focus on where we're at here. If wave A targets here, wave B targets here, that's wave 1. Then here's wave 1, and wave C should be bigger than wave 1. So we're going to move this up to here. And then we're going to say that wave D, the final wave, or E, should be bigger. Yeah, so we could do this. We could hypothetically go wave A to here, wave B to here, which I've drawn, wave C up to here or here, and then wave D here to here, and then wave E up. That could be a fairly valid scenario. Actually, this could be more of a parabolic, and ending around 2031. That would be this would be a logical structure. In fact, I'm going to kind of anchor this. I'm going to anchor this as a 2-point light purple, 2-point light purple. And again, ladies and gentlemen, the purpose of this is to show you how my research is different. How many people do you know who can put together a chart like this? Granted, it's, it right now, it may only be about a 20% chance of coming true, but what I'm doing is I'm using mathematics. I'm using Fibonacci, Gann, Tesla, Elliott wave price structure to try to show you what I believe is likely to happen. And I mean, I'm sure there are others out there that can do something like this, but I believe my research is far different from most people. And I believe the success that you generate by having this advanced knowledge and having someone like me show you what is going on and apply these studies without having to try to teach you all the nuances and the 20, 30 years of experience that I have is worth a pretty penny, especially if you have, a couple $100,000 or a couple million over in your retirement account. The reality is this MENT rotational modeling system is your end-all, be-all system, in my opinion. It adapts to the market. It beats the S&P by nearly 300% or more. The volatility is 35% lower than the S&P itself, SPY itself. The performance is stupendous. You can see here it's been matching the S&P in the early stages of the uptrend, and then it continued to outperform the SPY during corrections and during downtrends in 2000, 2002, 2008, 9, 10. We actually had a rally. And you can see as the markets extended this upward trend here, and remember, this was a 23-25% contraction. We didn't see that here. The maximum contraction period that we've had has been about 13.5%. So understand that your investment, if you stayed in the SPY, you've experienced multiple 30 to 55% contractions over periods of time. Whereas with the MENT rotational modeling system, those are gone. You're only seeing a maximum of about 13.5%. They've only happened a couple of times. Look at these contractions here, 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 and here. Generally, it's all to the upside. Recently, we've been kind of rolling around here. These are quarterly, by the way. And you can see here that we've been rolling around to the upside, kind of sideways, flattening out. Took a little bit of loss last quarter. Now we're looking, that's actually this quarter. Now we're looking to see some trending take place, which is going to keep us in some nice solid upward trending. Okay, so that's pretty much it for the investor side of it. If you are trading, come back over here. If you are trading, you want to remember this. You want to kind of remember this allocation level. So you would want to be 35% in your stock for discretionary trading, 25% cash, 25% metals, and 15% bonds. We just added the bonds position last week. We just added a little bit of bonds. The MENT rotational modeling system is still showing bearish, but I have a shorter term system that indicated we likely see some upward movement. Bonds have continued to move up a little bit. TLT is what I'm talking about. Has moved up a little bit. We'll ride that trend a bit, likely try to get out of it and move back into cash when we see some signs of weakness. The whole purpose behind this is to complement with your your investment account. So remember, if you had $10 million, theoretically you'd have $8 million in the MENT rotational modeling system. You'd have $1.5 million in this allocation level here for your trading account, and you'd have $500,000 as a liquid cash reserve. Okay, and you would just set that there to try to take advantage of any unusual opportunities that set up in the markets. It's always important to have liquid cash reserves. Okay, however you want to handle that, whether it's in short-term CDs or short-term bonds or something, you want to have some sort of a liquid cash reserve that you can get to in the event that things go a little haywire. You also want to have that liquid cash reserve to be able to pile into something when an opportunity strikes. Okay, so this would be your discretionary trading account with metals. This is your discretionary trading account without metals. Then your remaining 80% would be allocated into the SPY with the MENT rotational modeling system, like you're seeing right here. And this protects you against unforeseen drawdowns. You're not going to see the massive drawdowns, and you're going to be able to grow your wealth. The way I run it is through two accounts, basically having one allocation for weekly, one allocation for daily, but a combined account works just as well if you just have a single account and you want to try to move between cash and long and short SPY or SPY related funds. You can just run right here, no problem. Okay. All right, guys, that's it. I'm a little long today, but I got a lot of information. By the way, I'm going to be starting new webinars, so pay attention. New webinars and live events will be happening over the next couple of weeks. Pay attention and come join me for more research where you can share in and ask questions. All right, guys, talk later.